Hey everyone, Meet Kevin here, or Meet Kevin Paffrath as the judicial system likes me to be called. In this video, we're going to talk about some really incredible research that I've done over the last week, and it has to do with our favorite things. Inflation, wages going up, what might happen in the future, and some new facts and data that we've gotten, including from today. So folks, let's get right into it. Right after I mention that this video is of course sponsored by me, Kevin Paffrath, because I've got some amazing courses linked down below with the Stop the Bullshit coupon code, where you can get 40% off using that coupon code. Take advantage of that, link down below, and check out the amazing programs on building your wealth with real estate investing, stocks, trading, options. We've got real estate property management, making YouTube videos, you name it, check it out, link down below. Okay, first, let's go ahead and dive into this report. So I came across this absolutely incredible report, and it makes this argument that economies perform substantially the same after pandemics, but the way they perform is different than how you would expect. So they set up this argument. Okay, during a pandemic, people die, and that's bad. But people also die in natural disasters or in wars. But the problem is, in wars, you have a different outcome of what you tend to have happen after a pandemic. And so we want to talk about, what does that outcome look like? Now you might be thinking, okay, wait a minute, what pandemics? Well, this report looked at pandemics spanning the last 700 years, including the Black Death, the Spanish flu, the Asian flu, multiple plagues, cholera, you name it, and even adjusted for financial crises like the Great Depression, taking them out to make sure that we still had a consistent result. And every single time, this report found the same thing happen to economies after pandemics, which is really interesting. Now, initially, our expectation is, hey, well, we're probably going to see in a pandemic or after a pandemic that if there is all of a sudden a substantial loss of life, that we would expect wages to go up. If wages go up, usually inflation goes up. And when inflation goes up and wages go up, we usually expect something known as the neutral interest rate to go up. Now, the neutral interest rate is just a fancy way of saying that what is the interest rate an economy has to support full employment while keeping inflation steady. So in other words, if inflation is high, the neutral interest rate would naturally be higher. If inflation is lower, neutral interest rate would naturally be lower. And from now on, just to keep things simple, I'm just gonna say rates. So over time, we've had this sort of collapsing of rates. And this can easily be seen, well, not only just by us knowing that, but also by taking a peek at a chart like this. You can see that the neutral rate, the red line, has consistently gone down over the past 700 years. And this makes sense because even if we just specifically look at the last 20 years, or sort of the tiny little last bit of this chart, we tend to see the natural rate, or just rates we're gonna call it, go down. Why? Because technology helps foster deflation, not inflation. And this is why we've had this long trend to the downside. In fact, in the medieval era, we had rates around 10%. Neutral rate was around 10%. That collapsed to about 5% during the start of the Industrial Revolution around 1760, and now it's pretty much around 0. In fact, when you look at Europe, they're at like negative rates, which is kind of crazy to think about. But what was crazy about this particular report was not so much that, yeah, rates go down over time, but it's what I'm about to show you. It's what happened to different countries after pandemics and all of them together. So what you're gonna see is you're gonna see a blue squiggly line, and that's gonna show you what the natural rate did after pandemics, 0 to 40 years after. And around that, you're going to see these sort of bands, and that's where you had different results, but most of the results being concentrated along where that blue line is. So what I want you to picture right now before I show you this, okay, think about this for a moment. And if you're half paying attention, just stop for a second and think about this for a second, because in order for you to get the impact of this, you have to think about this. So what you're gonna think is, after a pandemic, would you expect rates to go up or down? Okay, that's it. Now, over what time frame? 5 years, 10 years, 20 years? What do you think rates would do over the 20 years after a pandemic? Go up or go down? Okay, you ready for it? Here is the result of 700 years worth of pandemics, with all of them providing these averages to us. Take a look, folks. Rates plummeted on average 20 years after a pandemic. Now, you started off sometimes with slightly higher rates, a slightly more noise. For example, here we had a little bit more noise, a little bit more uncertainty. But generally in the 20 years after a pandemic, we saw rates come down, which also means that inflation was coming down, which is really interesting because we also have wages going up like crazy right now. And how can wages go up, but rates like inflation not go up, right? I mean, if wages go up, then that increases the cost of production, which then businesses raise their prices. I mean, they're not going to take people's wages away, right? And if the prices of goods and services go up, well, that means inflation goes up, and that means you should have higher rates. But that's not actually what happened historically after pandemics. Now, maybe this time is different, but let me just put it this way. I don't like saying the phrase, this time is different. When history says something, I look pretty closely, and I look for reasons that say what has happened in the past is actually not going to happen again, right? Because history tends to rhyme and how it repeats itself. Okay, let's pause here and say it's kind of interesting that 5 to 10 years after a pandemic, you really start getting this plummeting of rates and likely inflation going down to help cause this, which is really interesting. Because at the same time as you get this sort of downtrend in rates, after both wars and pandemics, wages tend to go up. That is, people tend to get paid more money after both wars and pandemics, because a lot of people died and we need more people. But what's different after wars and pandemics is that after wars, the natural rate actually goes up 20 years after, where with pandemics, it goes down. And we could see that's caused by inflation. Over here, take a look at this. You have pandemics, which lead to 10 to 12% wage growth over this period of time. Substantial actual wage growth, inflation adjusted. Pandemics lead to good positive growth in wages. This is good for workers, people actually getting paid more adjusted for inflation. So now we're caught up with these weird long-term historical changes. But what does that mean in the short term, and why the heck are wages going up? I mean, wages are going up. That's not exactly aligned with inflation going down. Well, to help us answer this, take a look at what crazy thing happened right here when we compare wars to pandemics. That's definitely the wrong button. There, this is the right button. Look at this. Right here, at the 0-year mark, you had rates initially go up after pandemics. Look at this spot right here. See that blue line and this initial increase you have right there in pandemics? You actually had rates at first after pandemics on average go up, where they initially went down after wars. But that course actually reversed itself by about year 5. You started having an inflection point and a crossover by year 7 to 8 thereafter. And after about year 7 to 8 after a pandemic, look at this. You basically had mega low rates, lower inflation with pandemics. But with wars, you had higher natural rates, so higher inflation. And because you had higher inflation, workers got punished more after wars. Because after wars, even though in both cases people got paid more money, after wars, people's actual real wage growth was mostly negative for 10 to 30 years after a war. However, after a pandemic, the next 40 years looked like a solid line of real wage growth, which means wages going up above the rate of inflation. So this is actually very, very good. And in other words, this research is saying we should expect wages to actually grow more than they would have had it not been for the pandemic. And that's literally what's happening. In fact, it's kind of scary to say this, but this report was written in June of 2020, when there were only 500,000 COVID deaths worldwide. We're now over 4 million COVID deaths. And yet, now we're seeing that massive wage growth, which this report actually predicted. This report also predicts the same problem we're seeing now, that natural rates rise after a pandemic, and only about 7 or 8 years later do we get that big plummet. We don't end up getting any kind of like hyperinflation or hyper increase in real rates, but we do have a period of instability after a pandemic, much like after a war. Now, keep in mind, one of the reasons wars are so different, one of the reasons you might not actually be getting this real wage growth after pandemics is because risk goes up after a war. That is, people who invest demand greater returns on their money after a war because economic stability is actually riskier. Let me ask you this. What do you think was more risky, investing in America in March 20 or after the day after Pearl Harbor? Like, what would make you more nervous about investing, right? March 2020, go ahead, use hindsight, it's fine, right? In hindsight, it's like, well, wait a minute, duh. Like, the day after Pearl Harbor, you'd probably be like, oh my gosh, what if we're about to get invaded? We're going to war, this is scary. Uncertainty goes up substantially more after a war. And this is why real rates tend to go higher after wars, because uncertainty goes up. Whereas with pandemics, we actually have a little bit less uncertainty, but we do, as a human population, tend to save more on a personal level. We're more confident in our government, which I know politically that sounds crazy to say because our government's crazy, don't get me wrong, but you're certainly more confident than right after a war, right? And you have this situation where generally rates go down. All right, so now let's hit some bottom lines, because I know some of this was a little bit more detailed and granular, but I think that's why some of y'all come to the channel, to get some of this detailed kind of insight. So, bottom line of this report, and then I want to introduce some new things, is that after pandemics, you tend to see lower returns on assets as societies save more money, and you get lower returns on businesses who are now paying higher wages. But those businesses generally do not pass along all of the price increases to their customers, and certainly over the 20 to 40 years following a pandemic, you tend to be in a scenario of having lower inflation. You also tend to have higher wages in a real manner. That means real wage growth above inflation. So if inflation's 1%, maybe wages are going at 3 or 4%. And it seems weird, like, how could that happen? Wouldn't wages raise the rate of inflation? Not necessarily, because if the marketplace stays competitive and consumers say, you know what, I'm not going to pay higher purchase or prices, I'm going to save more instead, in other words, frugal decade, then the ability to raise prices erodes, prices stay low while wages go up. It's crazy, but history tells us that's what happens after a pandemic. So bottom line, in the short term, the first 2 or 3 years after a pandemic, lots of uncertainty. Longer term after a pandemic, low rates, lower yields. So in other words, you kind of have to prep for lower returns on investment and lower inflation in the long run. But there are some risk factors. A big risk factor actually has to do specifically with what Governor Waller of the Federal Reserve said today. Governor Waller mentioned that he has a real concern that what if businesses can raise prices and keep those prices high? Well, in that kind of case, it's possible that inflation may not be as transitory as we expect it will be. But that's not his base case scenario. So let me break that down very clearly. He believes that we are going to see inflation inflect downward. He thinks that's the likely case scenario. Towards the end of the year, we'll have less inflation. That things like car purchases and airline purchases and ticket prices and things like that aren't going to keep going up 10%, 10%, 10% forever, that they're going to inflect back down, and we're going to see a leveling off of these prices. But he does make the argument that the big risk factor is, what if we deviate? What if those prices stay up? And so this is where what I'm going to do is I'm going to draw a little bit of a sort of a game plan that I think will be a lot easier for us to follow. So basically, we believe, based on this report here, that in the long run, we're going to have lower yields. So we're going to write down lower yields and lower inflation, especially over the next, somewhere like 5 to 10 years, right? this time frame, and likely based on this historical report, but I don't like estimating that far out, even 20 years. So really like 5 to 20 years. Unless, and this is the key thing that we have to watch, unless, as Mr. Waller says, which right now he just references as being anecdotal, like him talking to businesses, unless businesses maintain price power. Price power is going to be the key here. So if we want to keep an eye on what the economy is likely to do going forward, we have to see how capable businesses are at consistently passing price increases along to their customers. Now, unfortunately, it's going to take time to see exactly how that plays out. But in the meantime, personally, I'm using a very simple strategy. When I'm investing, I'm trying to get myself, as usual, real estate below market value, undervalued real estate. I haven't really found that. I've been hunting. I will find something eventually. I always do, but it's been it's been slimmer pickings in the last few months, and I know that. In stocks, I'm not super excited about paying massively high valuations because, quite frankly, I think we should expect lower returns going forward in the future and slower returns. Lower and slower returns means lower implied volatility, which means stay away from things like bought call options. Instead, consider selling to pick up premiums, covered calls, and puts. So selling, and put selling puts or selling covered calls. Those are ways that you'd be able to farm yields. Obviously, I talk about this regularly in my programs like Stocks and Psychology of Money with Options and Trading. Link down below. Use that 40% off coupon code. But of course, you could also read a book if you want to. But anyway, these are things that, in my opinion, this report really helps us reiterate a lot of the beliefs that we have. Now, I'm always very cautious to say, oh, yay, I found a report that pats my strategy on the back that says, yeah, inflation in the long run will be lower. I get that. It's cool. I recognize my potential bias here, but at the same time, what I'm doing that's unique is I'm also looking for my risk factors, which is what usually folks don't do. They look at confirmation bias and then they don't look at their risk factors. So remember, what was our risk factor, folks? Businesses maintaining pricing power. If we go into a frugal decade, then people, consumers, are going to stop paying higher prices. They're going to choose to save instead. And after stimulus, the stimulus tap is completely off, after the unemployment tap is closed, I think businesses are going to lose that pricing power, and we are going to see that deflationary trend again. That's my belief. That's why I'm investing the way that I am. This is also why I'm not desperate to get into more real estate, because real estate's a good inflation hedge. And I'm not desperate to get in more because, quite frankly, if inflation's 1 or 2%, not that big of a deal. Hey, but rates will be lower. So anyway, things to think about. If you found this video helpful, consider subscribing, consider liking the video, sharing the video, and as always, check out the amazing programs linked down below. Thanks for watching. Bye.